Hi everyone. So I would just like to explain a very interesting financial concept today, which explains the inverse relationship between bond yields and prices. So what exactly does the inverse relationship mean? So if I try to explain, as the bond prices generally go up, the yields associated with it generally go down, and also the inverse is true. When the bond prices usually decrease, the corresponding yields rise. This is a very interesting financial concept. So if I try to explain the same, so let me just give you a very brief about what exactly are bonds. So let's say there's a company, let's name it this as a Reliance or Nvidia, whatever you like. So let's say it wants to raise, let's say rupees 1000 for whatever may be the reason, for their own capital, like acquisitions, some expenditures, some they want to acquire some other assets. So usually the lenders, or let's say investors, which are going to lend the sum of 1000 rupees to Reliance, usually would require some rate of return for lending this money. So let's say Reliance agrees to give them a rate of let's say 4% on the bond. So that would usually translate to 40 rupees divided by 1000. So that would be the 4% yield. Reliance agrees to pay this 4% yield to the lenders and investors who are actually lending this amount to the Reliance. So let's say the bond is usually for a tenure of 5 years. So as everyone knows, bond is generally a, let's say, a debt instrument in order to raise lands the money. So let's say for a particular, every year end the investor would rupees 40 rupees and interest, and at the end of fifth year investors would receive 40 rupees as interest, and also the 1000 rupees back as the initial amount which they had lent to Nvidia or Reliance, whatever the case may be. So this is generally the concept of the bond, of exactly how is it priced, and what exactly is a bond, and how do the companies or even governments or other municipal corporation bodies or whatever the case may be, they generally raise money by issuing bonds. So now coming to the point of the inverse relationship, so what exactly does it mean? So let's say I'll draw a column, I'll draw three columns rather. So let's say this is the price of a bond, this is the coupon, and this is yield. So you'll have to understand coupon and yield are two different concepts. So I'll just explain this. So let's say the price of a bond is 1000, the coupon rate is 4%, and the yield will be calculated as the coupon rate, which is 4% of 1000 divided by 1000, and it will again come to the 4%, which is same as yield. So we can say that this bond is trading at par. So now let's say, as recently RBI has decreased the repo rates, which are generally referred to as the market rates. So as the market rates decrease, the new bonds which would be issued would also require lower interest rate from borrowers. So let's say now the companies are issuing bonds giving yields 3.8%, 3.7%, whatever the case may be. The companies are now issuing bonds at these new interest rates. So now let's say the same Reliance bond is now trading at 1050. This is because this Reliance bond is paying the same interest 4%, which is generally greater than the current market rates. So as usual, this kind of bond is more lucrative for the investors, so the price has increased due to excessive demand. So now the coupon would be the same, right? The coupon generally remains the same throughout the tenure of the bond, but the now new yield would be calculated as the coupon rate, which is 40, and now it would be divided by 1050, which is the current price of the bond. And now if I calculate this yield, let's say I try to calculate this yield on a simple calculator, so which would come out to be 40 divided by 1050. That comes out to be somewhere close to 3.8%. So now you can see, as the prices of bonds have gone up, the yields have actually fallen down. So this generally explains our inverse relationship between the bond prices and the yields. So let's take a opposite example also. Let's say the price of the bond actually decreases. Let's say the price of the bond decreases to rupees 980. Maybe the rates have actually risen. The RBI has increased the repo rates, or whatever the market rates have risen. And now the new bonds are paying, let's say 4.1%, 4.2%, 4.5%, whatever the case may be. The new bonds are now issuing these kind of interest, but as Reliance is paying the same 4%, so now the new yield for this bond would be 40 divided by the current price of this bond. So if we can calculate this on the calculator once again. So now the new yield comes out to be, yes, 4.08%. So as you can see, the yield has actually increased when the price of the bond has decreased from 1000. So this generally corroborates and explains a concept such as when the bond prices usually go up, their yields come down, and when the yields are rising, the prices fall. So this is the inverse relationship between bond prices and yields, which generally explains, to sum it up in a single line, as the prices of bonds go up, the yields come down, and the vice versa is also true. So I think that's all from my side. If you have any more clarity, if you need any more clarity, please comment down whatever doubt may be. Let's see if we can solve it in the next video. Thanks.